If you've been watching the housing market from the sidelines for the past few years, you know the feeling.
Oh,
With
okay.
that
So,
feeling of being squeezed by almost no inventory and these bidding wars that felt less like a negotiation and more like, I don't know, a battle
a
royale.
gladiatorial combat.
Exactly. It was defined by stress, by urgency, and, for a lot of buyers, just feeling totally locked out.
Hmm.
But the material we're digging into today, it's from a strategic guide called the 2026 Housing Pivot, and it suggests that whole era of chaos might actually be ending.
It's a fascinating take.
It is. It's built on early 2026 data, and it's not predicting a crash, but something else, a pivot. A kind of profound structural shift that puts leverage back into the hands of the buyer.
The prepared buyer, which is key.
Yes, the prepared buyer. So our mission is to break down the strategic guidance, really focus on the four clearest data signals that this pivot is, actually happening.
Okay, let's unpack this. We've heard optimism before, but where does the data show this change really starting? Well, it's so important to frame this moment correctly. We're not looking at a market correction that's driven by, some kind of catastrophe.
Right.
The source material is very clear. 2026 is a transition year. It's a move toward what the industry would call a healthier, more balanced market.
So for anyone who felt just paralyzed by the volatility, what does this mean?
It means understanding these shifts early is your strategic advantage. It lets you move from just waiting on the sidelines to, acting with some real confidence.
And it's not just theoretical.
Not at all. That's the beauty of this analysis. It's
Yeah.
rooted in very tangible things that, directly impact your wallet. We're talking about a softening of that aggressive price inflation and a direct measurable drop in the median monthly housing cost.
Okay, so those are the big indicators.
Those are the indicators that tell us the whole market mechanism is finally, starting to change.
That brings us right into the first pillar of this pivot. I think for most people, the biggest frustration was the absolute lack of inventory.
No question.
Sellers were basically handcuffed by their 2 and 3% mortgage rates, and everything just ground to a halt.
The golden handcuffs.
Right. But the guide reports a break in that dynamic. Early 2026 data shows available inventory rising by nearly 13%.
13%.
Now, 13% sounds enormous, but the context here is everything, isn't it?
It is. While that jump really does change the buyer psychology, the sources are clear that we're still well below, say, pre-pandemic 2019 levels.
So it's a trend shift, not a full recovery to historical norms.
Exactly. So what does that modest but still significant inventory gain actually do for the buyer experience?
Well, it restores choice, I'd imagine.
It restores choice. That scarcity mindset is what fuels the frantic wave every single contingency bidding war.
Right.
A 13% rise in available homes, it just relieves that immediate pressure. And more importantly, it creates this crucial feedback loop.
Meaning what? Why are more sellers suddenly willing to move now?
Because they're seeing the second shift, which is easing price growth.
Ah.
For a while, prices only slowed because demand was just, priced out. People couldn't afford it. Now, the sources suggest prices are easing because inventory is creeping up.
Which is a very different dynamic.
It's a critical psychological factor for the seller. If they know the rate for their next home might be below 6%, and they aren't going to make another 20% just by waiting 6 more months, the incentive to stay put just disappears.
The golden handcuffs start to unlock.
Exactly. Easing price growth makes the next move feel less risky,
Right.
and that's what brings more inventory to the market.
Okay, that makes sense. But let me just be a little skeptical here for a second. How meaningful is easing price growth if, nationally prices are still way up from 5 years ago? Isn't this just a small win that's kind of masking a huge affordability gap that's still there?
That is the right question to be asking. And easing price growth alone, you're right, it doesn't solve affordability. But you have to pair it with the third pivotal shift, which is the mortgage rates themselves. The guide points to rates dipping below 6% as this really critical psychological milestone.
The magic number.
Kind of. I mean, when rates were at 7 or 8%, that created what the industry called payment shock. Dropping below 6 just makes the whole transaction feel possible again for a huge chunk of the population that was just locked out.
And if you combine that with wages going up.
Right. And the analysis assumes wage growth is steady. You combine that rate drop with wage growth, and it gives all those potential buyers who've been saving up a real injection of purchasing power.
And the sum of all these parts, more inventory, easing prices, lower rates, It all leads to the fourth metric, which is maybe the most immediate one for anyone listening.
The one that hits home.
Exactly. The median U.S. monthly housing payment has fallen to its lowest point in 2 years.
And that's the number.
That's the one that translates all the big economic talk into, your personal finances. If you've been comparing your rising rent to what a mortgage would cost, the sources say those numbers are finally starting to tip back in favor of ownership in a lot of markets.
They are.
But I want to push on this a bit. Lowest in 2 years. Still sounds pretty expensive historically, right? So how does the guide suggest buyers balance this new possibility with the reality of still high prices?
What's fascinating here is that the four signs together, the inventory, the easing prices, the rates under 6%, and the drop in the monthly payment, they do signal a return of real purchasing power. It's not just cosmetic.
Right.
But you're right, this is not a return to 2019 prices. The guide is very emphatic on this point. This is not a buyer free-for-all.
Okay, so that moves us perfectly into the next subject. Better options, yes, but not a free-for-all.
Exactly. The guide argues the market is normalizing, which means a poorly priced or, a poorly marketed home is going to sit.
But the good ones will still move.
Oh yeah, the well-priced homes in desirable areas will still sell quickly. The frenetic urgency is gone, but the competition in those prime neighborhoods, that's still there.
So if the market isn't demanding just pure speed anymore, what's the new key advantage for a buyer?
It's the shift from speed alone to what the guide calls smart timing.
Smart timing.
Yeah, the paralysis of the last few years where buyers felt they had to throw an offer in instantly or lose out, that's dissipating.
So you can actually take a breath.
You can take a breath. Now a buyer can afford to focus on the fundamentals, again, like inspections, appraisals, asking for due diligence. I mean, that is a massive psychological relief for someone who lost 5 bidding wars last year because they were afraid to ask for a financing contingency.
That is a critical difference. So smart timing means what exactly? You're prepared with your pre-approval, you have a clear budget.
Right, but you're also educated on the hyper-local market metrics. You really need to know the specifics. What's the average days on market in the specific neighborhood you're targeting? Is it 15 days or is it 90 days?
And that number tells you everything.
It tells you exactly how much leverage you actually have when you walk into that open house.
The guide also stresses that buyers still need realistic expectations, though, right?
Absolutely.
Yeah.
Just because the median monthly payment has dropped doesn't mean you should immediately go for the absolute top of your price range.
Don't get carried away.
Don't. The affordability challenge is still very real, and buyers need professional guidance to avoid overstretching. The market is rewarding strategy now, not just how much cash you can borrow.
Okay, so if we synthesize the buyer's mission from the source material, it's get your financing secure early, set a really tough, realistic budget, and this is the crucial part, understand your local market metrics for timing.
That preparation is what lets you capitalize on this pivot. It makes you the informed actor in a changing scene.
All right, now we move to segment 3, and this is where the guide sort of pivots itself. It goes from buyer advice to professional strategy. And I think it offers some deep insights into, market positioning and trust that are fascinating for anyone listening.
It's a complete perspective shift for real estate agents themselves.
How so?
Well, the sources argue that in that volatile market we just left, an agent's job was mainly transactional, right? Get the fastest offer, get the best price, coordinate all the logistics.
Sure.
In this new transitioning market, that role is becoming obsolete. The professional who wins in 2026 is the one who transforms into a true strategic advisor.
And that transformation hinges on what?
It hinges entirely on early and transparent education.
Why is that so important now?
Because the market pivot creates confusion. People hear inventory's up and they think market crash. They hear rates are down and they think buying frenzy.
It's the agent's job to cut through that noise.
It's the agent's job to proactively explain those 4 shifts we just talked about and articulate what they actually mean for their client.
That's so right. The conversation has to move away from just sales-driven messaging. I can sell your house for X amount.
Exactly. It's about helping clients interpret these complex market conditions. The real goal is to explain how more inventory and lower payments translate into a genuine opportunity.
While also keeping expectations balanced about the fact that prices are still high.
Precisely. It's all about building a foundation of trust.
And that trust needs to be backed by data.
And that trust needs data. The guide explicitly advises professionals to use third-party data from, trusted, verifiable sources. It even mentions firms like Redfin in their client communications.
So you can't just say, trust me, the market's improving.
No. You have to say, trusted third-party data shows a 13% inventory rise in our metro area, and that signals a return to more selection for buyers. It just immediately elevates your credibility beyond, anecdotal claims.
Here's where it gets really interesting for me, the actual communication strategy. The guide says professionals have to tailor their follow-ups.
Yes, by aggressively segmenting their database. They have to recognize that different types of potential buyers need very different kinds of education.
Okay, let's break down those segments. The guide suggests 3. First up, active buyers.
These are the people ready to go right now.
Right. They need the immediate, frequent updates on new inventory, breaking rate news. They're all about execution.
Then you have the second group, the prospective buyers.
These are the people who are kind of paralyzed by the chaos of the last few years.
Exactly. The uncertainty. They need content that's focused on the affordability pivot and on strategic timing. You have to convince them that the, paralysis of chaos is over and it's safe to start planning again.
So you're nurturing them back to confidence with data.
You're showing them the positive trend lines. And finally, the third group, past clients.
They aren't an immediate transaction, but they're critical for referrals and future business.
Right. So they get more general market insight,
Yeah.
high-level newsletters about how the pivot affects their existing home equity or how local neighborhoods are trending.
It keeps the professional top of mind, maintaining a relationship based on ongoing expertise, not just one past sale.
The biggest win in 2026, according to this analysis, it goes to the professional who understands that targeted, data-driven education is the new salesmanship.
The old transactional pushiness is losing ground.
It is. This market demands strategic advisory services, and the people who provide them are the ones who are going to build those long-term client relationships.
So, to synthesize this, the core conclusion of the strategic guide really holds up. 2026 is a transition year. Buyers are finally regaining some meaningful leverage, and the market is moving toward a healthier balance.
It's not a correction, it's a recalibration.
A recalibration, I like that.
For you listening, whether you're preparing to buy, thinking about selling, or just following the economy, the critical factor is recognizing this shift. Market power is moving away from being rewarded for just speed and cash,
And toward being rewarded for strategy.
and toward being rewarded by informed strategy. Those who deeply understand these 4 pivot points, the inventory rise, using prices, rates under 6%, and the drop in the monthly payment, they're going to be the ones who act most effectively and confidently this year.
So what does this all mean? The market is now rewarding strategic advisors and educated buyers. It's forcing an end to that purely reactive, frantic salesmanship.
Is that way.
So if this pivot to education and data is truly the defining trend of 2026, I have to wonder, does this signal a permanent end to the fastest offer wins mentality of the recent past? Is it being replaced, maybe for good, with a more measured, analytical approach to real estate for the foreseeable future?
That's a big question.
It is. But that shift in the very nature of the buyer-market relationship from scarcity and chaos to informed selection, that might be the biggest and longest-lasting change of all.